Salaries, revenue. It's the total money earned from selling products or services. Business goal. The main aim of any company is to make a profit, not just revenue. Other metrics. Investors consider other measurements too, like net income, which includes all expenses, to get a complete view of a company's profitability. Remember, the operating margin is a valuable tool, but it's not the only factor to consider when evaluating a company's financial health. Always look at the bigger picture and use multiple metrics for a thorough analysis. Profit margin is a measure of how much money a company makes from its sales. It's calculated by dividing the profit, either gross profit or net profit, by the total sales. There are two types of profit margins: gross profit margin and net profit margin. Gross profit margin is the profit a company makes after subtracting the cost of goods sold from the revenue. Net profit margin, on the other hand, is the profit after subtracting all expenses, including the cost of goods sold from the revenue. Having a higher profit margin is generally good for a company because it means they are making more profit on each sale. However, there could be strategic reasons for intentionally lowering the profit margin or even having a negative profit margin, like when a company wants to gain market share by selling a new product at a lower cost. The return on assets ratio, ROE, measures how effectively a company is using its assets to generate profit. It's calculated by dividing the net income, profit after all expenses and taxes, by the total assets. A higher ROA is better, indicating that the company is using its assets more efficiently to make money. It's important to note that both profit margin and ROA can vary widely depending on the industry and economic conditions. Also, ROA has its limitations, as it doesn't consider how the assets were financed or the difference between the carrying and market value of assets. In summary, profit margin tells us how much profit a company makes from its sales, while ROA measures how well a company uses its assets to make money. Both are essential indicators of a company's financial performance, but they need to be interpreted in the context of the company's specific circumstances and the industry it operates in. Profit margin. Simple explanation. Profit margin is like checking how much money a company makes from its sales. It tells us how much profit they earn for every dollar they make in sales. Mental model. Imagine you're running a lemonade stand. Your profit margin would be the money you earn from selling lemonade minus the cost of making it. A higher profit margin means you're making more money for each cup of lemonade you sell. Types of profit margin. Simple explanation. There are two types of profit margin: gross profit margin and net profit margin. Mental model. Think of gross profit margin as just looking at the money you make from sales minus the cost of making the product. Net profit margin, on the other hand, considers all the expenses like rent, wages, and taxes in addition to the cost of making the product. Importance of profit margin. Simple explanation. Having a higher profit margin is generally good for a company because it means they are making more profit from their sales. But sometimes, a company might intentionally lower the profit margin to attract more customers or gain market share. Mental model. Think of it like a game. You want to win by making the most money, but sometimes you might decide to lower your prices to get more people to play your game. Return on assets, ROE. Simple explanation. ROA tells us how well a company uses its assets, like money, buildings, and equipment, to make money. Mental model. Picture a bakery using ovens, mixers, and other equipment to make and sell delicious cakes. ROA is like checking how effectively they use these assets to make profits. ROA calculation. Simple explanation. ROA is calculated by dividing the profit a company makes, net income, by the total assets they have. Mental model. Imagine you have $100 in your piggy bank and you use that money to sell lemonade. If you make $20 in profit, your ROA would be 20% because you earned 20% of the money you invested. Limitations of ROA. Simple explanation. ROA has some drawbacks. It doesn't consider how the assets were paid for or their actual market value. Also, different industries might have different ROA averages. Mental model. Think of ROA as a simple measure like using a basic calculator. It can give you a good idea, but it doesn't give you all the details. Quick practice exercise. Company A makes $200,000 in sales and has a net profit of $40,000. Calculate the net profit margin. Answer. Net profit margin equals net profit slash sales. Asterisk 100 equals 40,000 slash 200,000. Asterisk 100 equals 20%. Company B has $500,000 in total assets and a net income of $50,000. Calculate the ROA. Answer. ROA equals net income slash total. Assets equals 50,000 slash 500,000 equals 0.10 or 10% advantages of knowing profit margin and ROA. Simple explanation. Knowing profit margin helps us understand how much money a company makes from sales and if they are pricing their products effectively. ROA tells us how well a company uses its resources to generate profit. Mental model. It's like having a scorecard for a company's financial health. Profit margin shows how well they're doing with sales, and ROA shows how efficiently they use their assets to make money. Disadvantages of knowing profit margin and ROA. Simple explanation. Profit margin and ROA don't tell a whole story. Other factors like debts and market conditions can also affect a company's performance. Mental model. It's like looking at a small part of a bigger picture. While profit margin and ROA are useful, they're not the only things to consider when evaluating a company's overall success. Remember, understanding profit margin and ROA can give you valuable insights into a company's financial performance, but they are just two pieces of a larger puzzle. Always consider other factors and context when analyzing a business. Profit margin. Profit margin measures how much profit a company makes from its sales. There are two types of profit margin: gross profit margin and net profit margin. Gross profit margin is the profit from sales minus the cost of goods sold, while net profit margin considers all expenses. Profit margin is calculated by dividing profit, gross or net, by sales. A higher profit margin is generally better for a company, but there are strategic reasons for having a lower or negative margin. Return on assets, ROA. ROA measures how effectively a company uses its assets, like money and equipment, to generate profit. It is calculated by dividing net income, profit after expenses and taxes, by total assets. A higher ROA indicates better asset utilization, but there's no specific good or bad ROA metric. ROA is based on the book value of assets, which might differ from their market value. Relationship between profit margin and ROA. Profit margin and ROA are related, as ROA is the product of profit margin and asset turnover. Asset turnover measures how much sales a company generates for each dollar of assets it owns. Companies with low profit margins and high asset turnover can still have a good ROA. Understanding profit margin and ROA helps assess a company's profitability and efficiency in using its resources. It helps in making informed decisions and comparisons with other companies. However, both metrics have their limitations, and additional factors should be considered when analyzing a company's financial health. Remember, profit margin tells you how much profit you're making for each dollar of sales, while ROA evaluates how well you use your assets to make money. Together, they provide a more comprehensive view of a company's financial performance. Return on equity, ROE, measures how well a company uses its money to make profits. To calculate ROE, we look at how much profit the company makes and divide it by the money invested by shareholders. Imagine you start a business with your friends and you want to know how good the business is at making money. ROE helps you figure that out. If your business is making a lot of profit compared to the money you and your friends put in, then you have a high ROE, which is great. It means you're doing a good job of turning your investment into profits. ROE can be split into different parts to understand it better. It depends on how much profit you make from each sale, net margin, how much money your business is generating from its assets, asset turnover, and how much debt you use to finance the business, financial leverage. Having a higher ROE is generally better, but what's considered good can vary depending on the type of business you have and the overall economic situation. Just remember, ROE is like a report card that tells you how well your company is doing at making money for you and your friends. A high ROE means your business is doing great, while a low ROE means you might need to find ways to improve. Imagine you and your friends start a business together, and you want to know how well the business is doing at making money. Return on equity, ROE, is like a report card for your business's money making skills. It tells you how effectively the business is using the money invested by you and your friends to generate profits. The higher the ROE, the better the business is at turning your investments into profits. 2. Mental models and analogies. The money multiplier. Think of ROE as a money multiplier. It shows you how much money your business is making for every dollar you and your friends put into it. Just like a good investment that grows your money, a high ROE means your business is doing a great job at multiplying your investment into profits. The football team. Imagine your business as a football team and the investors, you and your friends, are the players. ROE measures how effective the team is at scoring goals, making profits, with the players, investments it has. A high ROE means the team is scoring a lot of goals with the players on the field. 3. Example exercises. A. Calculate the ROE for a company that has a net profit of $200,000 and total equity, investment from shareholders, of $1 million. Answer. ROE equals $200,000 slash $1 million equals 0.2 or 20%. B. Company A has an ROE of 15% and Company B has an ROE of 25%. Which company is doing better at making profits with the money invested by shareholders? Answer. Company B is doing better because it has a higher ROE of 25%, indicating it's more effective at generating profits with the money from shareholders. 4. Advantages and importance. Advantages of ROE. It shows how well a company is using investors' money to make profits. Helps compare the performance of different companies, regardless of their size. Disadvantages of ROE. Doesn't consider debt and interest payments, so companies with high debt might have artificially inflated ROE. It can be influenced by accounting practices, making it less comparable across different companies. Importance of knowing ROE. For investors, understanding ROE helps in identifying how effectively a company uses their money to generate profits. ROE can reveal if a company is doing well financially and if it's a good investment choice. Overall, ROE gives valuable insights into how efficiently a company uses its equity to make money, making it a crucial metric for investors and business owners to assess financial performance. 12 key points to know in depth about return on equity. ROE. ROE measures how well a company uses its shareholders' money to generate profits. The formula for ROE is ROE equals net profit slash total shareholders' equity. Shareholders' equity represents the ownership interest in the company and is the difference between its assets and liabilities. ROE is a key financial ratio used to evaluate a company's profitability and efficiency. ROE can be broken down into 3 components: net margin, profit margin, asset turnover, and financial leverage. Net margin measures how much profit the company makes from each sale. Asset turnover shows how efficiently the company uses its assets to generate sales. Financial leverage refers to the use of debt financing to boost returns for shareholders. A higher ROE is generally better, as it indicates the company is effective at turning invested capital into profits. However, there is no universal standard for a good or bad ROE, as what is considered good varies across industries and economic conditions. Too much debt in the company's capital structure can increase financial risk and lower ROE. Understanding ROE helps investors assess a company's financial health and how effectively it generates returns for shareholders. In summary, ROE is a vital metric for evaluating a company's profitability and efficiency in using shareholders' investments to generate income. A higher ROE is generally preferred, but it's essential to consider industry norms and economic factors when interpreting the ratio. Imagine you have a friend who wants to start a business. They have some money and resources, but they also have some debts they need to pay back within the next year. To understand if their business can handle these debts, we use something called the current ratio. The current ratio is like a math formula that helps us see if the business has enough money to cover its short term debts. To calculate it, we look at two things: the current assets, which are things the business owns and can quickly turn into cash, like cash itself, inventory, and money owed by customers, and the current liabilities, which are the debts the business needs to pay back soon, like bills and loans. Here's how we calculate the current ratio. We divide the current assets by the current liabilities. For example, if the current assets are $1,500 and the current liabilities are $1,000, then the current ratio would be 1.5. $1,500 slash $1,000 equals 1.5. Now, the current ratio is like a report card for the business's financial health. A ratio between 1.5 and 3 is considered good for most businesses. If it's below 1, that means the business may struggle to pay its debts, which is not good. If it's too high, like more than 3, it might mean the business is not using its money efficiently. Different types of businesses can have different current ratios depending on how they work. Some businesses, like ones with fast-selling products, might have a current ratio less than 1, but that's okay for them because they can quickly turn inventory into cash to pay their debts. In short, the current ratio helps us see if a business can pay its short-term debts on time. If the ratio is healthy, it's a good sign for the business's financial strength. But if the ratio is not so good, it may need to make some changes to manage its money better and meet its obligations. Current ratio in simple terms. Think of the current ratio as a test that checks if a company has enough money to pay its bills in the next year. It's like checking if you have enough money in your bank account to cover your expenses for the next 12 months. 2. Mental model. Water bucket analogy. Imagine a company's finances as a big bucket filled with water. The current assets are like water being poured into the bucket, and the current liabilities are like holes in the bucket that let water out. The current ratio measures if the water level in the bucket, current assets, is enough to cover the holes, current liabilities. If there's too much water, high current ratio, it might spill and go to waste. If there's too little water, low current ratio, the bucket might run dry and the company can't pay its bills. 3. Example exercise. Let's practice with an example. Company XYZ has $50,000 in current assets and it owes $30,000 in current liabilities. Calculate the current ratio for company XYZ. Answer: current ratio equals current assets slash current liabilities. Current ratio equals $50,000 slash $30,000. Current ratio equals 1.674. Advantages and importance. Advantages of knowing the current ratio. It helps companies and investors see if a business is financially healthy in the short term. It allows businesses to plan and manage their finances better to meet their obligations. Disadvantages. The current ratio only gives a snapshot of the company's financial health and doesn't consider long-term prospects. Different industries have different acceptable current ratios, so it's not a one-size-fits-all measure. Why is it important to know the current ratio? For businesses, it ensures they can pay their bills on time and avoid financial problems. For investors, it helps assess the company's ability to manage its money and potential risks. In simple terms, the current ratio is like a financial health check for a company's short-term money management. It's essential to make sure the company can pay its bills and run smoothly. In a nutshell, the current ratio measures a company's ability to handle short-term debts. It's like checking if the company has enough money in the bank to pay its bills on time. This information is crucial for both the company and its investors to know if things are going well financially. Remember, different industries have different acceptable ratios, so it's not the same for all businesses. Let's break down the 12 key points you should know about the current ratio and liquidity ratio. The current ratio is a financial tool that checks if a company can pay its debts in the next year. It compares what the company owns, current assets, to what it owes, current liabilities. Liquidity ratio. The liquidity ratio shows how easily a company can pay off its short-term debts using its available cash. It's like checking if you have enough cash in your wallet to cover your small expenses. Calculation of current ratio. To find the current ratio, divide the current assets by the current liabilities. Current ratio equals current assets slash current liabilities. Acceptable range. A healthy current ratio varies by industry but generally falls between 1.5 and 3. Ratios within this range indicate good financial health for most businesses. Working capital management. It refers to how a company manages its short-term money and finances. This involves handling relationships between short-term assets, things that will turn into cash soon, and short-term liabilities, debts to be paid within a year. Video reference. You can watch a video on lynda.com to understand current and liquidity ratios better. Liquidity ratio equation. The liquidity ratio formula is liquidity ratio, LAR, equals liquid assets slash short-term liabilities. It shows how many times the short-term debts can be covered with available cash. High liquidity. When a company has high liquidity, it means it can easily pay its short-term debts, just like having enough cash in hand to cover your bills. Liquidity ratio examples. Liquidity ratio can refer to various things, like bank reserve requirements or the acid test ratio that measures how well a business can pay its short-term debts without selling inventory. Current assets and current liabilities. Current assets are things a company owns that can be converted into cash within a year, like cash, inventory, and accounts receivable. Current liabilities are debts to be paid within a year. Importance of current ratio. A healthy current ratio is crucial for a company's financial well-being. It ensures they can meet their short-term obligations and avoid financial trouble. Low current ratio exceptions. Some businesses, like those with fast-selling inventory, may have a current ratio less than 1. This doesn't always mean trouble if they can manage their finances well. Understanding the current ratio and liquidity ratio is essential for both businesses and investors to assess financial health and make informed decisions. It helps determine if a company can handle its short-term debts and if it is using its resources efficiently. By knowing these ratios, you can gain insights into a company's financial strength and potential risks. The acid test, also known as the quick ratio or liquid ratio, is a financial measure that helps us understand how well a company can pay off its immediate debts using its readily available assets. It looks at the company's ability to handle its short-term financial obligations. To calculate the quick ratio, we add up the most easily accessible assets that can be turned into cash quickly, like cash, marketable securities, and accounts receivable, and then divide that total by the current liabilities, the debts that the company needs to pay within a short period, usually a year. The formula for the quick ratio is quick ratio equals cash plus marketable securities plus accounts receivable slash current liabilities. Ideally, a company's quick ratio should be 1 to 1 or higher. This means it has enough quick assets to cover its current debts. However, the acceptable ratio can vary depending on the industry the company operates in. Generally, the higher the quick ratio, the more financially stable and capable the company is of meeting its short-term financial obligations. It's important to keep in mind that while the quick ratio provides some insights into a company's financial health, it doesn't give a complete picture. Other factors, like how quickly the company's customers pay their bills and how fast the company needs to pay its own bills, also play a role in determining the company's overall financial situation. In summary, the acid test, or quick ratio, helps us understand how well a company can pay off its immediate debts using its readily available assets. A higher quick ratio is generally better, but what's considered good can differ between industries. It's one of several tools used to assess a company's financial health. Simplified explanation: the acid test, or quick ratio, is a way to check how quickly a company can pay its bills and debts. It looks at the company's ability to use its readily available assets. like cash and easily convertible assets, to cover its immediate debts. If the quick ratio is less than 1, it means the company might struggle to pay its current debts right away. Mental model. Imagine you have a piggy bank and a jar of candy. The piggy bank is your cash, and the jar of candy represents other assets that you can quickly convert into cash, like selling it to your friends. Your debts are represented by IOU notes. The acid test is like checking if you have enough money in the piggy bank and enough candy that you can quickly sell to pay off all your IOUs. If you have more money and candy than the total IOUs, you are in good shape. Example exercises. A. Calculate the quick ratio for a company with the following data: cash and cash equivalents, $10,000 marketable securities, $5,000 accounts receivable, $7,000 current liabilities, $15,000 answer. Quick ratio equals cash plus marketable securities plus accounts receivable slashed current liabilities. Quick ratio equals $10,000 plus $5,000 plus $7,000 slash $15,000. Quick ratio equals $22,000 slash $15,000, 1.47 bits. Explain why having a quick ratio of less than 1 can be a problem for a company. Having a quick ratio of less than 1 means that the company doesn't have enough quick assets to cover its current debts immediately. It may face difficulties in paying its bills and obligations on time. Importance and advantages/disadvantages. Understanding the acid test, quick ratio, is crucial for several reasons. Liquidity check. It helps assess a company's short-term financial health and how well it can handle immediate financial responsibilities. Risk indicator. A quick ratio of less than 1 might indicate that a company is at risk of facing cash flow problems and may not be able to pay off its debts promptly. Comparing companies. It allows for comparisons between different companies in the same industry to see which ones are better positioned to meet their short-term obligations. Advantages. Provides a quick assessment of a company's short-term liquidity. Helps investors and creditors gauge a company's ability to meet its immediate financial obligations. Disadvantages. Doesn't consider all assets and liabilities, so it doesn't give a complete financial picture. The acceptable quick ratio can vary across industries, making direct comparisons challenging. In summary, the acid test, quick ratio, is a measure of how quickly a company can pay off its immediate debts using its readily available assets. It is important to understand because it gives insights into a company's short-term financial health and ability to meet its short-term obligations. However, it's essential to use this ratio alongside other financial metrics to get a comprehensive view of a company's financial situation. 12 key points to know in depth about the acid test. Quick ratio. Purpose. The acid test, quick ratio, measures how well a company can pay off its immediate debts using its easily accessible assets. Quick ratio formula. Quick ratio equals cash plus marketable securities plus accounts receivable slashed current liabilities. Acid test ratio formula. Acid test ratio equals current assets, inventory, slashed current liabilities. Ideal ratio. Ideally, the quick ratio should be 1 to 1 or higher, indicating that the company has enough quick assets to cover its current liabilities. Industry variation. The acceptable quick ratio varies across industries, so what's considered good can be different for different businesses. Liquidity indicator. A higher quick ratio suggests better liquidity, meaning the company can handle its short-term obligations effectively. Quick assets. Quick assets are assets that can be easily converted into cash or used up within a short time, such as cash, marketable securities, and accounts receivable. Cash equivalents. Cash equivalents are highly liquid assets that can be converted into cash quickly, such as treasury bills, money market holdings, and short-term government bonds. Cash is king. Cash is the most liquid asset in a business and plays a crucial role in determining a company's ability to meet its immediate financial obligations. Difference from current ratio. The acid test ratio excludes inventory, making it a stricter measure of a company's ability to pay off short-term debts compared to the current ratio. Limitations of ratios. Ratios, including the quick ratio, provide valuable insights, but they don't give a complete picture of a company's overall financial health. Interpreting the ratio. A company with a quick ratio of less than 1 might have difficulties paying off immediate debts, while a ratio higher than 1 suggests a healthier financial position. Understanding the acid test, quick ratio, is essential for investors, creditors, and company management to assess a company's liquidity, financial stability, and its ability to meet short-term obligations. However, it should be used alongside other financial metrics and considerations for a comprehensive analysis of a company's financial health. The debt ratio is a way to measure how much of a company's assets are funded by debt. It shows the percentage of the company's assets that are paid for using borrowed money. A higher debt ratio means that the company has a greater amount of debt compared to its assets, which can be risky for the company. Financial ratios like the debt ratio are important tools used to understand different aspects of a business. They help in comparing companies to see how they are performing financially. However, it's essential to compare ratios with other companies in the same industry or with the industry average because different industries face different risks and requirements. Now let's talk about the price-to-earnings ratio, PE ratio. This ratio is used to assess the relative value of a company's stock. It compares the market price of a share to the earnings per share, EPS, of the company. EPS is the profit a company makes for each share of its stock. A higher PE ratio means investors are willing to pay more for each unit of the company's earnings, which can make the stock more expensive. On the other hand, a lower PE ratio indicates that investors are paying less for each unit of earnings, making the stock comparatively cheaper. PE ratio is useful when comparing different stocks within the same sector or industry. It helps investors understand if a stock is overvalued or undervalued based on its earnings potential. Companies with higher expected earnings growth usually have higher PE ratios, while companies with uncertain or lower earnings growth tend to have lower PE ratios. Managers of companies often focus on increasing their stock prices as part of their responsibilities to shareholders. They may do this by increasing earnings or by increasing the market's perception of their earnings potential, which can influence the PE ratio. In conclusion, the debt ratio tells us how much debt a company has compared to its assets, while the PE ratio helps investors understand the value of a company's stock based on its earnings. Both ratios are important tools for analyzing and comparing companies, but it's crucial to consider the industry and other factors when making these comparisons. Debt ratio. Imagine you're buying a house, but you don't have all the money to pay for it, so you take a loan from the bank. The debt ratio is like checking how much of the house's price you borrowed compared to how much you paid with your own money. It shows if you have a lot of debt compared to what you own. The higher the debt ratio, the riskier it is for the company because they have more debt to repay. Mental model. The house purchase. Think of a company as a person buying a house. The total debt is the mortgage they take to buy the house, and the total assets are the entire value of the house. The debt ratio is like looking at how much of the house's price is covered by the mortgage. If the mortgage is too big compared to the house's value, it's a risk for the person because they have a lot of debt to handle. Example exercise. Let's practice calculating the debt ratio for a company. Company XYZ has total debt of $500,000 and total assets of $1 million. Calculate the debt ratio for company XYZ. Answer. Debt ratio equals total debt slash total assets. Debt ratio equals $500,000 slash $1 million. Debt ratio equals 0.5 or 50% advantages and disadvantages. Debt ratio, advantages, helps assess a company's ability to handle long-term debt, provides an idea of the company's financial risk, allows comparisons between companies to see which ones are more leveraged. Disadvantages may not consider short-term financial situations. Difficult to compare companies in different industries. Doesn't take into account the company's potential for growth. Importance. Understanding the debt ratio is crucial for investors and creditors. It helps them evaluate a company's financial health and its capacity to repay debts. High debt ratios can signal higher risk, which might make investors cautious about investing in that company. On the other hand, a low debt ratio indicates a more stable financial position, making the company an attractive investment option. 12 key points you should know about the debt ratio and price to earnings ratio, PE ratio. Debt ratio. The debt ratio measures a company's ability to repay long-term debt by showing the percentage of its assets financed through debt. It is calculated as total debt divided by total assets. A higher debt ratio indicates a greater risk associated with the company's operations. High debt ratio may signal low borrowing capacity and lower financial flexibility. Comparisons of a company's debt ratio should be made against its industry average or competing firms. Price to earnings, PE, ratio. The PE ratio is a valuation metric used to compare the relative values of companies in the stock market. It is calculated as market price per share divided by annual earnings per share. A higher PE ratio suggests investors are paying more for each unit of current net income, making the stock more expensive. Different types of PE ratios include trailing PE, based on the most recent 12-month earnings, trailing PE from continued operations, using operating earnings, and forward PE, using estimated earnings for the next 12 months. PE ratio helps investors analyze a company's stock valuation based on its income generation. Stocks with higher forecast earnings growth generally have higher PE ratios, while those with lower or riskier earnings growth have lower PE ratios. Managers focus on increasing stock prices, often by improving earnings or increasing the market's valuation multiple assigned to those earnings, as it aligns their interests with shareholders. Remember, the debt ratio assesses a company's debt level in relation to its assets, while the PE ratio measures the market's valuation of a company's stock based on its earnings. Both ratios are valuable tools for investors and analysts when evaluating companies. The price-to-book ratio, P/B ratio, is a financial tool that helps us compare a company's market price with its book value. The book value is the company's net worth based on its financial statements. We can calculate this ratio in two ways. First, by dividing the company's total market value by its total book value, and second, by dividing the current share price by the book value per share. A higher P/B ratio means that investors believe the company will make more money from its assets. It's like saying they expect the company to use its resources well and be profitable. However, the P/B ratio alone doesn't tell us if the company will actually make profits or generate cash for its shareholders. Ratio analysis is a method to understand a company's financial health by looking at its financial statements. We use different ratios to get insights into different aspects of the company. For example, we have liquidity ratios that tell us how well the company can pay its short-term debts. There are also profitability ratios that show how well the company can generate profits from its operations. Comparing ratios over time or with other companies in the same industry helps us see if the company is doing better or worse. It's like checking if a company is improving or facing problems. We can also use ratio analysis to set goals and compare the company's performance against benchmarks or industry standards. Ratio analysis is essential for making smart decisions about a company's future. It helps investors and analysts evaluate how well the company is doing and predict its future performance. The price-to-book ratio, P/B ratio. Analogy. Price and value of a used car. Think of the P/B ratio as comparing the price of a used car with its book value. The price is what someone is willing to pay for the car, and the book value is the car's value based on its condition, age, and features. If the car is in great shape and has desirable features, its book value might be higher than the asking price, indicating a good deal. On the other hand, if the car has issues and lacks important features, its book value might be lower than the asking price, suggesting it's overpriced. Exercise. Q. If a company's market value price is $50 per share and its book value per share is $30. What is the P/B ratio? A P/B ratio equals price per share slash book value per share equals $50 slash $30 equals 1.67 ratio analysis. Mental model. Health checkup for companies. Imagine doing a health checkup for a company, just like you would for a person. The financial ratios are like different tests that help you understand the company's financial health. Just as your doctor looks at various indicators like blood pressure, cholesterol levels, and heart rate to assess your health, ratio analysis looks at different financial metrics to assess a company's liquidity, profitability, and efficiency. Analogy. Puzzle pieces. Think of each financial ratio as a puzzle piece. When you put all the pieces together, you get a complete picture of the company's financial situation. Each ratio provides valuable information, and combining them gives you a comprehensive view of the company's strengths and weaknesses. Exercise. Q. If a company has a current ratio of 2.5, a debt-to-equity ratio of 0.8, and a gross profit margin of 40%, how would you interpret these ratios? Are they good or bad signs for the company's financial health? A. A current ratio of 2.5 suggests good liquidity, meaning the company can pay its short-term debts easily. A debt-to-equity ratio of 0.8 indicates a moderate level of debt, which is generally positive. A gross profit margin of 40% means the company is making a reasonable profit on its products or services. Advantages and disadvantages of ratio analysis. Importance. Financial health snapshot. The advantages of ratio analysis are that it provides a quick snapshot of a company's financial health. It helps investors and managers understand how the company is performing and whether it's efficient, profitable, and able to manage its debts. It also allows comparisons with industry peers and historical data to spot trends. Potential pitfalls. Limited scope and interpretation. However, ratio analysis has its limitations. Some ratios might not be meaningful for certain industries, so understanding the context is crucial. Also, ratios alone don't give the complete story, and they should be used in conjunction with other data and qualitative factors for a comprehensive assessment of the company. Understanding financial ratios and ratio analysis is essential for investors and managers to make informed decisions about companies and their financial performance. By using these mental models and analogies, you can better grasp the concepts and apply them effectively. 12 key points to help you understand the topic of the price-to-book ratio, P/B ratio, and ratio analysis price-to-book ratio, P/B ratio. The P/B ratio compares a company's market price to its book value. Book value represents the company's value based on its balance sheet, including assets and liabilities. It shows how much investors are willing to pay for each dollar of book value. Calculation of P/B ratio. There are two ways to calculate it: by dividing market capitalization by total book value or by dividing the current share price by the book value per share. Both methods should yield the same result. Higher P/B ratio implication. A higher P/B ratio suggests investors expect the company's management to create more value from its assets. It indicates higher investor confidence in the company's future prospects. Inclusion of intangible assets. The P/B ratio can be calculated with or without including intangible assets and goodwill. When excluding these intangible assets, it becomes price to tangible book value. Comparing P/B ratios. P/B ratios vary by industry due to different capital requirements and business models. Companies needing more infrastructure capital generally have lower P/B ratios. Use of P/B ratios for banks. P/B ratios are commonly used for comparing banks because their assets and liabilities are usually valued at market prices. P/B ratios and profitability. P/B ratios don't directly show a company's profitability or ability to generate profits or cash for shareholders. Insight into market expectations. P/B ratio gives an idea of whether investors are paying a fair price for the company's assets. High P/B may indicate optimism, while low P/B may suggest undervaluation. Distressed companies and diluted basis. For distressed companies, intangible assets may be excluded from book value, and P/B should be calculated on a diluted basis, considering stock options. Other names for P/B ratio. P/B ratio is also known as market to book ratio and price to equity ratio, not to be confused with P/E ratio. Its inverse is called the book to market ratio. Ratio analysis purpose. Ratio analysis is a quantitative method to gain insights into a company's liquidity, efficiency, profitability, and solvency. Types of ratio analysis. Ratio analysis includes various types like liquidity ratios, solvency ratios, profitability ratios, efficiency ratios, coverage ratios, and market prospect ratios. These key points should help you build a foundation for understanding the price-to-book ratio and the broader concept of ratio analysis in finance. Remember to practice using these concepts with real-world examples and exercises to reinforce your understanding. Ratios are important tools that help investors understand how well a company is doing. They compare different aspects of a company's financials to see if it's a good investment. Here are 6 common ratios and what they tell us. Working capital ratio. This ratio checks if a company has enough short-term assets, like cash, to pay its short-term debts, like bills. A higher ratio is good because it means the company can easily cover its bills. Quick ratio, also called the acid test. This ratio measures a company's ability to pay its immediate debts using only its quick assets, assets that can be quickly turned into cash. A ratio above 1 is usually considered healthy. Earnings per share, EPS. EPS tells us how much profit each share of a company's stock makes. A higher EPS is better because it means more profit for investors. Price-earnings ratio, P/E. The P/E ratio helps investors see if a stock's price is reasonable based on its earnings. A lower P/E may mean the stock is undervalued, while a higher P/E could mean it's overvalued. Debt to equity ratio. This ratio looks at how much a company relies on borrowed money to operate. A lower ratio is generally safer because it means the company is less dependent on debt. Return on equity, ROE. ROE shows how well a company uses its shareholders' money to generate profit. A higher ROE means the company is doing a good job of using investor funds wisely. Remember, using just one ratio is not enough to make a decision. It's best to look at several ratios together to get a complete picture of a company's financial health. Financial ratios for investors' mental model. Financial health check. Imagine you want to know if a company is financially healthy before investing your money. Just like a health checkup, financial ratios are like vital signs for a company's health. They help you see if the company can handle its bills and if it's making enough profit to be a good investment. Analogy. Ratios as comparing tools. Think of financial ratios like a magnifying glass. They help you zoom in and compare different companies more easily. It's like using a magnifying glass to see details that you can't see with your naked eye. Ratios let you compare how well companies are doing, so you can pick the best one to invest in. Quick quizzo. What does the working capital ratio measure? Why is it important for investors? The working capital ratio measures a company's ability to pay its short-term debts with its current assets. It's important for investors to know if the company can handle its immediate financial obligations. B. How is the quick ratio different from the working capital ratio? B. The quick ratio focuses on a company's ability to pay short-term liabilities using assets that can be quickly converted to cash. It excludes inventory because selling inventory can take time. C. What does the price-earnings ratio, P/E, tell investors about a stock? C. The P/E ratio tells investors how much they are willing to pay for $1 of a company's earnings. It helps them understand if a stock is expensive or undervalued. Why is it essential to use multiple ratios instead of just one when evaluating a company? D. Using multiple ratios gives a more comprehensive view of a company's financial health. One ratio may not give the whole picture, but looking at several ratios together provides a clearer understanding. Advantages of financial ratios: easy comparison. Ratios make it easier to compare different companies and make informed investment decisions. Quick insights. Ratios provide quick insights into a company's financial health without having to read through complex financial statements. Identifying trends. By tracking ratios over time, you can identify trends in a company's performance and assess its growth. Disadvantages of financial ratios: limited scope. Ratios only focus on financial aspects and may not consider other important factors like industry trends or management quality. Interpretation challenges. Understanding ratios in isolation can be misleading. For a complete analysis, multiple ratios and context are necessary. Data quality. Ratios rely on accurate financial data, and if the data is flawed, the analysis may be unreliable. Importance of knowing ratios. Understanding financial ratios is crucial for investors because it helps them make informed and rational investment decisions. By assessing a company's financial health through ratios, investors can minimize risks and maximize their potential returns. It's like having a map to navigate through the complex world of investments, making your journey smoother and more successful. 12 key points about financial ratios and fundamental analysis, explained in simple terms. Ratios track company performance. Ratios are tools that help investors understand how well a company is doing financially. They compare different aspects of a company's financial information to make informed investment decisions. Fundamental analysis. This is a method that uses data from a company's financial statements to determine its true or intrinsic value. It helps compare a company's actual worth with its market value. 6 basic ratios. There are 6 essential ratios commonly used in investing: working capital ratio, quick ratio, earnings per share, EPS, price earnings, P/E ratio, debt to equity ratio, and return on equity, ROE. Working capital ratio. This ratio measures a company's ability to pay short-term debts using its current assets. A ratio above 1 is good, as it indicates healthy liquidity. Quick ratio, acid test. It assesses a company's ability to pay immediate debts using its quick assets, easily convertible to cash. A ratio above 1 means the company can manage short-term liabilities. Earnings per share, EPS. EPS shows the profit earned per share of a company's stock. A higher EPS means a greater share of profit for each investor. Price earnings, P/E ratio. This ratio compares a company's stock price with its EPS. A lower P/E might indicate an undervalued stock, while a higher P/E may suggest potential growth. Debt to equity ratio. It helps investors assess a company's level of debt compared to its equity, shareholders' ownership. A low ratio is often preferable as it means less dependency on borrowed money. Return on equity, ROE. ROE measures how efficiently a company uses shareholder money to generate profits. Higher ROE signifies better profitability. Importance of using multiple ratios. A single ratio may not provide a complete picture of a company's financial health. It's essential to use multiple ratios together to get a comprehensive view. Application of fundamental analysis. Fundamental analysis is valuable for investors to determine if a stock is priced correctly, undervalued, or overvalued. It contrasts with technical analysis, which focuses on price trends. Consideration of P/E ratio. Whether a higher or lower P/E ratio is better depends on your investment goals. A lower P/E could indicate a potential bargain, but a higher P/E may reflect strong market confidence in the company's future. Understanding these key points will help you become a more informed investor and make better decisions when selecting stocks for your investment portfolio. The DuPont equation is a way to understand how well a company is performing by breaking down its return on equity, ROE, into 3 parts: profit margin, asset turnover, and financial leverage. Profit margin. This shows how much profit a company makes for each dollar of sales. If the profit margin increases, the company earns more from each sale, leading to a higher overall ROE. Asset turnover. This measures how efficiently a company uses its assets to generate sales revenue. A higher asset turnover means the company is making more sales with fewer assets, resulting in a higher ROE. Financial leverage. It indicates how much a company relies on debt financing compared to equity. When a company uses more debt, it can increase its ROE because of tax deductions on interest payments. DuPont analysis helps companies understand why their ROE changes over time and how they can improve profitability, asset efficiency, and financial structure. Return on equity, ROE, is a measure of how well a company generates profits using the money invested by shareholders. A ROE of 15% to 20% is generally considered good. The formula for ROE is ROE equals net income slash shareholder equity. While ROE is important, stock prices are more influenced by earnings per share, EPS, rather than just ROE. EPS represents the earnings earned per share of a company's stock. A high ROE is beneficial if the company reinvests earnings into the business or distributes them as dividends. But if the company doesn't do either of these, a high ROE may not lead to immediate benefits. Think of the DuPont equation as a tool that helps companies understand why they are making a certain amount of money on their investments. It's like a recipe that breaks down the ingredients of their profits. It looks at three main things: how much profit they make from each sale, profit margin, how efficiently they use their assets to make sales, asset turnover, and how much they rely on borrowing money, financial leverage. By looking at these three parts, companies can figure out what they are doing right or wrong and improve their overall performance. ROE, on the other hand, tells you how well a company uses the money that shareholders have invested in it. It's like measuring how much bang for your buck you get from investing in that company. A good ROE is usually between 15% and 20%. But remember, high ROE is only valuable if the company uses those earnings wisely by reinvesting them or sharing them with the shareholders. Mental models and analogies. A. The profitable cake shop. Imagine a cake shop that measures its success with a special cake formula called the cake shop equation. This formula consists of three factors: the deliciousness of each cake, profit margin, how quickly they bake and sell the cakes, asset turnover, and how much they borrow to expand the shop, financial leverage. By understanding these factors, the cake shop can make more money and become even more popular. B. The three-legged stool. Think of the DuPont equation as a three-legged stool, with each leg representing profit margin, asset turnover, and financial leverage. For the stool to be stable, for the company to have a good ROE, all three legs need to be strong and balanced. If one leg is weak, the stool becomes wobbly and the company's profitability suffers. Example exercises. A. Calculate the return on equity, ROE, of company X given the following information: net income, $1 million, total shareholder equity, $5 million answer. ROE equals net income slash total shareholder equity. ROE equals $1 million slash $5 million. ROE equals 0.2 or 20%. B. Company Y has a profit margin of 20%, an asset turnover of 2.5, and a financial leverage of 1.8. Calculate the ROE for company Y answer. ROE equals profit margin asterisk asset turnover asterisk financial leverage. ROE equals 0.20 asterisk 2.5 asterisk 1.8. ROE equals 0.90 or 90%. Advantages and importance. Advantages. The DuPont equation helps companies analyze and improve their profitability, asset efficiency, and financial structure. It provides a clear breakdown of factors influencing ROE, making it easier for companies to understand their financial performance. Analysts can use DuPont analysis to compare companies within the same industry and identify areas for improvement. Disadvantages. DuPont analysis may not be as relevant for industries where certain factors are less meaningful or not applicable. It focuses on historical data, so it may not fully account for future changes or market dynamics. Importance: understanding the DuPont equation and ROE is crucial for companies to make informed financial decisions and improve their performance. Investors use ROE as an important metric to assess a company's profitability and management's ability to generate returns on their investments. Financial analysts use DuPont analysis to gain insights into a company's financial health and compare its performance with competitors. By using these mental models and practicing the example exercises, you'll have a better grasp of the DuPont equation and return on equity, making it easier to understand and remember this important financial concept. 12 key points to know in depth about the DuPont equation and return on equity (ROE). DuPont equation. The DuPont equation breaks ROE into three parts: profit margin, asset turnover, and financial leverage. This helps companies understand their financial performance better. Profit margin. It measures how much profit a company makes for each dollar of sales. Higher profit margins mean more profit from each sale, leading to a higher ROE. Asset turnover. This ratio shows how efficiently a company uses its assets to generate sales revenue. Higher asset turnover means more sales per asset and a higher ROE. Financial leverage. It refers to the use of debt to finance a company's operations. More debt can increase ROE because of tax deductions on interest payments. DuPont analysis helps analysts understand why ROE and ROA, return on assets, vary over time among companies and across industries. Competitive advantage, something that sets a company apart from its competition. DuPont analysis can help identify factors contributing to a company's competitive advantage. DuPont equation formula. ROE equals profit margin, X, asset turnover, X, financial leverage. Understanding ROE changes. Splitting ROE into its components helps companies see how changes in profit margin, asset turnover, or financial leverage impact their overall ROE. Industry relevance. Some industries may rely more on one factor of the DuPont equation than others. This analysis helps determine which factor is dominant for a company's ROE. Good ROE range. ROE between 15% and 20% is generally considered acceptable for a company's performance. Limitations of ROE. A high ROE doesn't guarantee immediate benefits. Stock prices are influenced more by earnings per share (EPS) than just ROE. Importance of reinvestment. The true benefit of a high ROE comes from reinvesting earnings into the business or distributing them as dividends. Understanding the DuPont equation and ROE is essential for companies to make informed financial decisions, evaluate their performance, and compare their standing with competitors in the same industry. It also helps analysts and investors assess a company's financial health and potential for growth. Imagine you own a company and it makes a profit from its business activities. Now, you have two choices on what to do with that profit. You can either give some of it back to the people who own shares of your company, that's you and other shareholders, in the form of dividends, or you can keep it within the company to use for future growth. The part of the profit that you distribute to shareholders is called dividends. These dividends can be in the form of cash, store credits, or additional shares in the company. When you get dividends, it's like getting a reward for being a shareholder. But remember, dividends are taxable, so you may need to pay some taxes on them. The dividend payout ratio tells you how much of the profit is given out as dividends to shareholders. The rest of the profit that's not paid out as dividends is kept within the company, and we call this retained earnings. It's like saving money for the company's future plans and growth. Companies usually decide on a fixed schedule to pay dividends, but sometimes they may give out special dividends on top of that. Also, some companies have a plan where instead of giving you cash dividends, they automatically use that money to buy more shares for you. When a company wants to give out dividends, it can either give out cash or issue new shares to shareholders. Issuing new shares is kind of like a stock split, where the number of shares increases, but the overall value of your shares remains the same. Return on equity and return on assets are two important ways to measure how well a company is doing financially. Return on equity shows how good the company is at generating profits from the money invested by its shareholders. Return on assets, on the other hand, shows how profitable the company's assets, things it owns, are in making money. Return on assets is a significant factor in calculating return on equity, and it's like the foundation of the calculation. It helps us understand how profitable the company is before considering other financial factors. Finally, there's something called capital intensity, which is all about how much of the company's resources are in fixed assets, like buildings and machinery, compared to other factors like labor. Companies with a higher capital intensity may require more initial investment, but can potentially grow faster by using tools and machinery more effectively. In summary, the dividend payout ratio tells you how much of a company's profit is given to shareholders as dividends, while the rest is kept as retained earnings. Return on equity and return on assets show how well the company is doing financially, and capital intensity measures how much the company relies on fixed assets for its growth. Dividends and retained earnings. Imagine your friend owns a lemonade stand, and every day they make money by selling lemonade. At the end of the day, they have two options. Either they can share some of the money with their family, that's the shareholders, or they can save it for future plans, like buying a new lemonade machine or expanding the business. When they share the money with their family, it's like giving dividends. But when they keep some money for future plans, it's called retained earnings. This way, the lemonade stand can grow and make even more money in the long run. Dividend payout ratio and retention ratio. Let's stick with the lemonade stand example. The dividend payout ratio is like a rule that your friend follows. It's the fraction of the money they made that they decide to give to their family as dividends. So if they made $100 in a day and they decide to give $40 to their family, the dividend payout ratio would be 40/100ths, which is 40%. The retention ratio is just the opposite. It's the part of the money they keep for themselves to use for the lemonade stand's growth. So in this example, the retention ratio would be 60/100ths, which is 60%. Example exercise. Let's say a company made a total profit of $10,000 in a year. They decide to give $2,000 of that profit to their shareholders as dividends. Calculate the dividend payout ratio and the retention ratio for this company. Answer. Dividend payout ratio equals dividends slash net income equals $2,000 slash $10,000 equals 0.2 or 20% retention ratio equals 1. Dividend payout ratio equals 1 to 0.2 equals 0.8 or 80% advantages and disadvantages and importance. The advantage of giving dividends is that shareholders get a direct return on their investment. It's like getting a bonus for being a part owner of the company. However, the disadvantage is that when the company gives out dividends, it has less money left for its future plans and growth. On the other hand, retaining earnings can be beneficial because the company can use that money to invest in new projects, research, and expansion. It's like saving up to make the lemonade stand even better and earn more money in the future. But the disadvantage here is that shareholders won't get immediate cash rewards, and some investors may prefer regular dividends. Knowing about dividend payout and retention ratios is essential because it helps investors understand how a company manages its profits. High dividend payouts may indicate a stable and mature company, while high retention ratios suggest a company with plans for growth. As an investor, you can decide if you prefer companies that give regular dividends or those reinvesting in their business for future growth. Understanding return on equity and return on assets also helps investors gauge how efficiently a company uses its resources to generate profits. Return on assets shows how well a company's assets, like machinery and equipment, are contributing to its earnings, while return on equity shows the return for shareholders' investment. These metrics give you insights into a company's financial health and profitability. In summary, think of dividends as the rewards a company gives to its owners, shareholders, and retained earnings as savings for the company's future growth. The dividend payout ratio tells you how much is given as dividends, while the retention ratio shows how much is kept for the company. These metrics, along with return on equity and return on assets, help investors make informed decisions and understand how well a company is doing financially. 12 key points to know of dividend payout, retention ratios, return on assets, return on equity, and capital intensity, dividends and retained earnings. Dividends are the profits that a company earns with its shareholders as a reward for owning shares in the company. Retained earnings are the profits that a company keeps within itself to reinvest in the business for future growth and expansion. Forms of dividends. Dividends can be paid in cash, store credits, or additional shares in the company. Cash dividends are a common form and are usually taxable to the recipient in the year they are paid. Dividend payout ratio. The dividend payout ratio is the portion of net income a firm pays to its stockholders in dividends. It shows how much of the profit is distributed to shareholders as dividends. Retention ratio. The retention ratio is the portion of net income that a company retains for reinvestment. It is the complement of the dividend payout ratio, meaning it shows how much profit is kept by the company. Stock split. A stock split is when a company issues a higher number of new shares to replace old shares. It increases the total number of shares outstanding without changing the market capitalization of the company. Dividend payments and earnings retention. Dividends represent the portion of corporate profits paid out to shareholders. Retained earnings refer to the portion of net income retained by the company instead of being distributed as dividends. Shareholder equity and dividend schedule. Retained earnings are shown in the shareholder equity section of the company's balance sheet. Public companies usually pay dividends on a fixed schedule, but they may also declare special dividends at any time. Dividend reinvestment plans, DRIPs. Some companies offer dividend reinvestment plans where shareholders can use their cash dividends to buy more shares automatically. Stock dividends. Stock dividends are paid out in the form of additional shares of the issuing corporation or another company. They are usually issued in proportion to the number of shares owned, leading to more shares but without changing the market value. Return on assets, ROA, and return on equity, ROE. Return on assets measures how profitable a company's assets are in generating revenue. Return on equity shows how well a company uses investment funds to generate earnings growth for its shareholders. Capital intensity. Capital intensity refers to the amount of fixed or real capital present in relation to other factors of production, like labor. Rising capital intensity can boost labor productivity and overall company growth. Importance of ratios and metrics. Dividend payout and retention ratios help investors understand how a company uses its profits and plans for the future. Return on assets and return on equity provide insights into a company's financial health and efficiency. Understanding capital intensity helps assess a company's reliance on fixed assets and its potential for growth. By grasping these key points, you will have a solid foundation to understand and analyze a company's financial performance and decision-making processes.